been a very conducive year as far as Indian macro is concerned. Our growth slowdown was much lower than the global growth slowdown. I think the overall GDP numbers are pretty robust. When you look at the internals of those numbers, you will see that investments is something that's starting to pick up. You had a multi-year drought on investment activity in India, and I think that's now starting to reverse. So I think that's a very positive change. Consumption is something that's been in the slow lane, but again, there inflation had a role to play because higher inflation hurt disposable incomes. Now, with inflation starting to soften, I think you're already getting early signs that even consumption might be starting to turn the corner. The external sector continues to face headwinds from global growth, but again, there the slowdown so far has been a little more muted than what you would have otherwise feared. Going into 2024, I think this combination continues to be conducive for India. If there's one risk, that is obviously from the global sector, and which is, if you think of China, for example, China is already slowing down. When you think of the US economy is also started to slow down. And, if you were to think that the lagged impact of monetary tightness in US is still to play out, then US can slow down a bit further, and that will obviously have at least an impact on the Indian external sector. But amidst all this, I think one silver lining because of global headwinds has been the fact that commodities have been in the slow lane. And that commodity softness is something that's aided the macro tailwinds for India. Now, for whatever reason, if that changes, whether it's because of geopolitics or any other reasons, if commodities start to flare up, that obviously is a headwind or a risk for Indian macro going into 2024. And lastly, for emerging markets like India, political stability, policy stability matters a lot. So far, the indications are that you will continue to see that. But again, that's something to watch out for. But on balance, I would say that the Indian macro situation stays fairly stable and do not see much reason to worry on that. So, we tend to look at equity valuations relative to where bond yields are. So for us, valuations mean a very simple measure, which is that you look at what is the yield that you're getting from equities and compare that to the yield that you're getting from bonds. So we think of it as a simple spread, earnings yield minus bond yields. And on that spread, we are a bit expensive as far as overall market valuations are concerned. So given where the bond yields are, ideally, the starting PE for equity valuations ought to be a little lower, which is not the case today. So to that extent, yes, equity market valuations are a little expensive to begin with. But then I think what you also tend to focus on as long-term investors is the overall earnings trajectory. And again, we tend to measure the earnings cyclicality in India through a simple measure. We look at corporate profits in India as a proportion of GDP. And if you track that ratio, that ratio was secularly declining between 2008 and 2020. We all remember that during that period, census earnings growth was a meager 4-5% per annum. GDP was still growing at 12-13% in nominal terms. So there was a big earnings recession, but thankfully over the last 2-3 years that has started to reverse. So profit growth is again is sort of printing strong numbers now and much better than the nominal GDP growth numbers. And usually, these profit cycles last for 6, 7, 8 years at a time. If history is any guide. And that I think gives you confidence that we are still in early stages of an earnings expansion cycle. Now, yes, the starting valuations are expensive, and hence some of that earnings improvement is already in the price. But if these earnings continue to come through for the next few years, then I think as equity investors, we should be in good shape overall. So I think from a here and now point of view, we don't want to sort of hazard a guess on short-term market movements. But yes, this combination of strong earnings and a bit expensive starting valuations would mean that while you should not see a big downside in the market, but perhaps the upside will also be a bit muted. So either an anemic up move or a sideways grinding market, that looks like a very high probability at this point in time. I think the most interesting aspect of a bull market is that, in a bull market, typically investors become very conscious of what they want to buy, what they want to avoid. And in that sense, they tend to become very selective. And I think there are famous sayings around this that whenever there are bubbles that are created in the market, there are also anti-bubbles that are being created. So we also tend to track a very simple measure called correlation between stocks. And usually in a rising market, correlation between stocks tend to fall. In a falling market, everyone just comes out and sells everything lock, stock and barrel. So in a falling market, correlations between stocks rise. In a rising market, correlations tend to fall. And that creates a set of opportunities because there are several sectors which have been completely shunned by investors. Today, there are, pockets, for example, consumption, as I talked about earlier. Consumption has been in slow lane over the last few quarters. But again, you also need to keep in mind the fact that we are at $2,300 per capita GDP. And historically, as countries and as economies have moved from 2,000 to $3,000 per capita GDP, discretionary consumption as a category has seen a big fillip. So I think that's one pocket that at this juncture looks like it's being ignored by the markets largely because the last few quarters have been weak. But we continue to think of it as a pocket which is more structural in nature. And there are several other such pockets which will keep on providing opportunities at different points in time. But this is definitely one pocket to watch out for. So I think I briefly tried to cover this already. I think one pocket that we definitely like at this point in time is discretionary consumption. And as I said, as the countries move from $2,000 to $3,000 per capita GDP, you not only do you see a big fillip in discretionary consumption, but a related category that also tends to do well is investments in savings related products. Because as you sort of earn more, your ability to save and invest also increases. So whether it's insurance companies, asset management companies, capital marketplace, I think that's another allied sector that we are positive on in addition to discretionary consumption. So I think that's first theme. The second theme, again, is going back to the manufacturing theme. We think that this entire investment-led recovery in India is for real. And consequently, investment and manufacturing related plays, whether it's direct manufacturing plays, whether it's industrial companies that provide equipment to these manufacturing plays, whether it's good quality lenders that sort of lend to this investment activity. I think that's the second pocket that we continue to be bullish on from a structural standpoint. And the third piece, I think the way we look at the global macro today, I think if there is one policy change that's happened over the past few years, is that from being a very monetary policy driven world, we've now graduated to become a bit of a fiscal policy driven world. So you remember that period from 2010 to 20, interest rates were close to zero. There was a lot of monetary accommodation. But last couple of years or more have been more about a lot of fiscal expansion. And that policy mix in general is very conducive for physical assets. So whether it's real estate, whether it's infrastructure, or whether it's natural resources like commodities. And again, if you think of the last decade or so, commodities have been significant underperformers versus financial assets. So I think at this point, it would make sense to diversify a bit into physical assets. And from a stock market point of view, also to have some exposure to hard assets and commodity related plays. So I think those three themes, discretionary consumption and investments in savings, manufacturing and allied plays, and hard assets and commodities are the three pockets that we are most positive on. So I think, first of all, the global macro is still a little fragile as we speak. China is still slowing down. US could slow. US has started to slow down. It could slow down more if the policy tightness has a lag impact on growth. And that obviously means that investors should be a little selective when they are thinking of the external sector. So domestic economy is fine, but when you are investing in externally focused sectors, I think it still is not the time to be too adventurous. The second risk, I think, is on commodities. And as I said earlier, one strong positive for Indian macro over the past year or so has been soft commodities. If for whatever reasons, whether it's geopolitics or apart from geopolitics, any other reason, if commodities start to flare up, and again, our view is that in a world where fiscal policy becomes the key driver of policy making, you will have high growth and high inflation and such an environment is usually conducive for commodities. So I think to the extent that Indian macro is very vulnerable to high commodities, having some exposure to commodity related plays in the portfolio also becomes a natural risk mitigant for Indian investors. So I think that's another risk, and a way to mitigate that risk would be to have some exposure to commodity and related plays. The third risk obviously is the political event that's upon us. Policy continuity is very important for emerging countries, and again, the mitigant to that risk is to keep the long term view and continue sticking to your asset allocation principle. I think on asset allocation, unfortunately, there is no one size fits all. So it's a function of your life, your aspirations, your goals, and your time frame. But at this stage of my life, I've been a little heavy on equities. So at this point, 80% of my allocation is towards equities. The balance 20% is towards multi-asset funds, sovereign gold bonds, balance advantage funds, and so on. That's an interesting one. I would still be researching. If not researching stocks, I would probably be researching in the academic world. So perhaps research in chemical engineering, which is a field that I chose for my graduation, or research in the field of finance as an academic professional. But I'm sure I would still be a researcher. Favorite book? I think let me give you two names instead of one. If you're into heavy reading, then I think Thinking Fast and Slow by Daniel Kahneman is a book that one must not miss. This is about how you think, and I think it will change the way you think. So, Thinking Fast and Slow by Daniel Kahneman is number one. The second read is a relatively light read, but it's on similar lines. It will help you sort of rethink the way you think. It's a book called Think Twice by Michael Mauboussin. I mean, the one mantra that I typically tend to follow at all points in time is that am I better than what I was yesterday as an individual, as an investor, as a professional, as a family man, as a person?